Before you choose between these two accounts, I need to show you something that will make you realize you have been answering the wrong question for your entire career. What if the debate everyone is having is built on a false premise? The average American spends 11 years contributing to the wrong retirement account, or no retirement account at all, because nobody ever explained the correct priority order, not the debate, the sequence. The average American leaves $127,000 in unclaimed retirement wealth because of this confusion. That number right there, that is what the Roth IRA versus 401k debate is costing you. Not because the accounts are complicated, because the debate framing keeps you choosing instead of sequencing. In the next 10 minutes, I am going to give you the exact three-step sequence that maximizes both accounts. The priority order the comparison videos never tell you. Stay until the end. Step 3 is the one most people reach age 65 never knowing. Step 3 is worth up to $200,000 more at retirement. Here is the exact trap the entire internet has built around this topic. Every video, every article, every Reddit thread on this subject is structured as a competition. Roth IRA versus 401k. Pick a side, defend it. The comment sections fill up with people arguing for their team as if one of these accounts is objectively better than the other. But what if neither account wins? What if the question itself is the problem? The truth is this: a Roth IRA and a 401k are not competing products. They are two components of a single tax diversification strategy. One is tax-advantaged on the way in, the 401k. One is tax-advantaged on the way out, the Roth IRA. They are designed to work together. The question is not which one. The question is in what order, at what amounts, for your specific situation. And if you get the order wrong, you literally pay more in taxes than you have to for the rest of your life.
Before I give you the sequence, I need to show you the two landmines that are destroying people's retirement accounts right now. Because even people who are using both accounts are often triggering one of these. Landmine 2 is the one high earners hit without ever knowing it exists. Landmine 1, skipping the free money floor. Your employer offers a 401k match. Let's say they match 50% of your contributions up to 6% of your salary. That is an immediate 50% return on your investment before the market moves a single point. If you earn $60,000 and contribute 6%, that is $3,600 from you. Your employer adds $1,800. You have earned a guaranteed $1,800 return before the market opens on Monday morning. That is not a metaphor. That is the actual mechanics of your benefits package. 42% of Americans with 401k access do not contribute enough to claim their full employer match. That means people are leaving free money on the table every single year. Landmine 2, the income trap most people hit at exactly the wrong time. Here is the second landmine, and this one is specifically for people whose careers are progressing. The IRS caps your ability to contribute directly to a Roth IRA based on your income. In 2025 and 2026, if you are a single filer earning above $146,000, your Roth IRA contribution limit begins to phase out. Above $161,000, you cannot contribute at all. This means that if you are building your retirement strategy entirely around a Roth IRA and your income crosses this threshold, your strategy breaks. The higher your income goes, the less access you have to the account you planned around. So what do high earners do? There is a legal workaround. This is called the backdoor Roth strategy, and it is one of the most undersold tax moves available to people in the $150,000 to $400,000 income range. We will cover it in the solution. Here's what you've been waiting for: the exact three-step priority sequence in order for anyone earning any income at any stage of their career. This is not my opinion. This is the sequence that maximizes your tax efficiency and total retirement wealth based on the actual structure of U.S. tax law. Step 3 only applies to about 15% of people, but for them, it is worth 6 figures. Step 1, 401k up to the employer match. Always, no exceptions. The first dollar of every retirement contribution goes into your 401k up to the exact percentage your employer matches. Not a cent more, not a cent less. This is the one move in personal finance with a guaranteed, risk-free, immediate return. The employer match is free money. It is part of your compensation package. Not taking it is the equivalent of declining part of your salary. You do this regardless of whether you like your investment options in the 401k. You do this regardless of the expense ratios on the funds available. The match return, which is typically 50% to 100% of your contribution, makes all other considerations irrelevant at this stage. For example, a $3,600 contribution plus an $1,800 match gives you $5,400.
That is a 50% guaranteed return before the market opens. Step 2. Max your Roth IRA. If you are under the income limit, once you have claimed every cent of your employer match in the 401k, stop. Move to the Roth IRA. In 2025 and 2026, the contribution limit is $7,000 per year, or $8,000 if you're 50 or older. Why does the Roth IRA come second? Because of when you pay tax. The 401k gives you a tax break today. Your contributions reduce your taxable income right now, but you pay tax when you withdraw in retirement. The Roth IRA takes after-tax money now, but everything inside grows completely tax-free. Every dividend, every capital gain, every dollar of appreciation, zero tax on withdrawal. $7,000 per year in a Roth IRA at a 7% average return starting at age 30 reaches $1.37 million by age 65, entirely tax-free. There is also a feature of the Roth IRA that almost nobody in the comparison videos mentions. Your contributions, not your earnings, just your original contributions, can be withdrawn at any time, for any reason, without penalty or tax. This makes the Roth IRA simultaneously a retirement account and the best emergency fund extension available. You put in $7,000, the account grows to $10,000. The original $7,000 is yours to access without penalty at any moment. The $3,000 in gains stays locked until retirement to maximize compounding. This is the account doing two jobs at once. But what if your income is above $146,000? Step 3, return to the 401k for the remainder or use the backdoor Roth. Once your Roth IRA is maxed, if you have more money to invest for retirement, go back to the 401k and continue contributing up to the annual limit. The logic is simple. You now have tax-diversified retirement savings. Some of your wealth will be taxed on withdrawal, the traditional 401k. Some will be tax-free, the Roth IRA. In retirement, you can draw from both strategically, depending on your tax bracket in any given year. This flexibility alone is worth tens of thousands of dollars in tax optimization over a 20 to 30-year retirement. If your income is above the Roth IRA phase-out threshold, the backdoor Roth strategy is your legal alternative. Here is how it works in 2 steps. First, contribute $7,000 to a traditional IRA. There is no income limit on contributions, only on deductibility. Then immediately convert that traditional IRA to a Roth IRA. This conversion is taxable, but typically results in very little tax owed if done before the contribution earns significant returns. The result? You have effectively made a Roth IRA contribution despite earning above the limit. The IRS allows this. It is not a loophole, it is a documented and widely used strategy by financial planners.
Just ensure you have no other pre-tax traditional IRA balances. Otherwise, the pro rata rule creates an unwanted tax event. If you have an existing traditional IRA, speak with a tax advisor before executing. Every year you delay implementing this sequence is another year of suboptimal tax treatment on your retirement savings. Let me show you the actual numbers, because this is the moment everything clicks. Person A earns $55,000. With the correct sequence, they capture a $1,650 employer match, they contribute $7,000 to a Roth IRA.
Total tax-advantaged amount becomes $11,150. At 7% over 30 years, that becomes about $1.13 million, with a significant portion tax-free. But person A with the wrong order opens only a Roth IRA. No employer match captured. Total contribution, $7,000. At 7% over 30 years, that becomes about $840,000. Difference, negative $290,000. Person B earns $95,000. With the correct sequence, they capture a $2,850 match. They max the Roth IRA at $7,000. Then they return to the 401k for $5,000 more. Total, $17,550. Over 30 years, at 7%, that becomes about $1.78 million. But if person B skips the match and only uses the 401k, they lose Roth diversification. Same dollar amount going in, different tax outcome coming out. That can mean hundreds of thousands of dollars in unnecessary withdrawal taxes over retirement. The sequence does not just change how much you accumulate, it changes how much of that accumulation you actually keep after tax. Now, here is what to do today. Today, log into your employer's 401k portal. Find your current contribution percentage. Set it to at least the minimum required to capture 100% of the employer match. This single action takes 5 minutes and is the highest guaranteed return investment you will make this year. This week, open a Roth IRA if you do not have one. Fidelity and Vanguard are consistently top-rated for low-cost, set-and-forget index fund investing. Set up an automatic monthly contribution of whatever you can manage, even $100. This month, calculate your income against the Roth IRA phase-out threshold. If you are approaching or above $146,000, speak to a tax advisor about the backdoor Roth strategy before year-end. Every year of delay is a missed contribution window you cannot get back. Which of these 3 steps can you complete in the next 24 hours? Here is everything you now know that the top 10 videos on this topic never told you. 1. The Roth IRA versus 401k debate is built on a false binary. You are not choosing between them, you are sequencing them. 2. Step 1 is always the 401k up to the employer match, the one investment in personal finance with a guaranteed immediate return. 3. Step 2 is the Roth IRA, not because it beats the 401k, but because tax diversification is worth 6 figures over a retirement lifetime. 4. Step 3 is returning to the 401k, or executing the backdoor Roth if your income has crossed the phase-out threshold. Instead of a debate, subscribe right now. Every single week, I produce a video exactly like this one, evidence-based, no filler, built around giving you the accurate information to make your own best decision. The next video in this series is going to show you exactly how inflation has been silently destroying your savings, not just in obvious ways, but through 3 mechanisms that most finance content never covers. Link is right here. Watch it immediately after this one. And drop a comment below. I want to know one thing. Which step in the sequence are you currently at? 1, 2, or 3? I read and reply to every comment. See you in the next one. Every week, one financial truth most people never find. Subscribe so you never miss one.